Good morning, everyone. Thank you for being here today. And thanks, Marty, for that nice introduction. So my name is Ming, and I am the founding managing partner at Upshot Ventures. We are an early stage fund based in Silicon Valley, where office is right in Palo Alto, if you know the area. And we do have a bit of a unique approach, a platform-based approach to access the C-stage deal flow. And in the next 20 minutes, I'm hoping that we could share with you our secret sauce on how we were able to scale that 30 unicorn from C stage to the unicorn stage. And then, we'll hold for questions to the end, but feel free to make this interactive as well. So just a little bit of market overview to put us all on the same page. And I know the first speaker of the day sort of paints a pretty, I would call dismal picture of the public market. And it's a bit of a doom and gloom. On the private market side, it's not as doom and doom, it's not as doom and gloom, but it's a little bit of slowdown. So according to data that we collected from PitchBook, you can see on the left-hand side of the graph, the deal makings are slowing down. They slow down. They peak in 2021, right after COVID. But then in 2022, the deals are coming down. And then we're projecting in Q1 2023, which is not shown there on the deal side, it's slowly slowed down. Two drivers for that, really. Investors are just being more intentional. They're being more deliberate in their deal making. And the market on the private side definitely has pivoted to more investor friendly rather than founder friendly. And what that just means is that investors could take their time and you don't have to rush and get to that term sheet stage right away. And then the other phenomena that we see really is that what we call in Silicon Valley, the tourist investors have left the stage, right? So the upmarket really have encouraged a lot of buyers from multiple disciplines. But most of that have left a lot because of maybe liquidity issues, and some of them left maybe because of mismatch in return expectations. But again, it's not so bad because the deal making still is higher than 2019, which is what we call the pre-pandemic years. So deals are still getting done. Then we cut over to the valuation side of the equation, and then we then dissect the valuation again on stages. And you could see that most of the decline are coming from that late stage or the growth stage of the company. But then the angels and the C stage investors are seeing pretty steady valuation, and that's demonstrated by that solid blue line and the sky blue line on the two. And so the reason for that, mostly, obviously, when the company gets to the later stage side, they're closer to the public market, so they feel that pendulum just a little bit more. And then we see it in our own portfolio companies as well. When you get to be a little later in that growth stage, you try not to tap the capital market if you can. So a lot of companies are reducing burn. A lot of companies are stretching out their runway so that they don't need to go out to the market. But when they do have to go out to the market though, because if you're a later stage company, you do require a larger pool of capital. You need that commercialization support to commercialize your product. So because of that, the market is saying, well, you're just not going to get the same valuation that you're getting. So why is C stage holding the valuation? And the reason is because what we have seen really is that the C stage markets are really, it's when companies are just raising their first institutional round. And at that point, it's still very much founder driven. Investors are investing in stage companies because of the founder, because it's founder market fit. And so that's why the valuation, it's holding at that founder value. So if you are a valuable founder and you're out there raising your first institutional round, you could still command that valuation that matches what you promised to deliver for that market. So that's why we believe that's why the early stage valuations are holding semi-study for a past decade, actually. This is data collected on PitchBook since 2013 to 2023, so for the last year, 10 years, sorry. So that bring me actually today to even further say, now I'm trying to make a case for early and seed stage investment, because this is what we've been doing since our inception, is what we've been doing for decades. And a lot of people are saying that, early stage really is the place to be now, maybe because it's a safe harbor for the public market that I just shared with you. But for us, it is something that we've been doing for a very long time. So looking at this is data collected from AngelList on the left-hand side since 2013. And what we realize is that significant value are created in the earliest years of a company's existence. And then, we're all smart people in the room. We know that winners created in those early years get, by definition, more time to then enjoy the higher rate of growth so they can deliver that compounded return to the investors. So that's why the graph also shows that in year 5 of a company's existence, from a time compounding value perspective, a year 5 company is only at about 20% of its year 1 value, or 50% of its year 2 value. And another way to say the same thing really is to a venture investor. If you were to come in a year 5 or later, you have essentially missed the majority of the value creation for this particular company. So what does this mean in real life? A case study from one of our own portfolio companies. As you can see here, most of the value was created for Series C. In fact, all the rounds after the C stage, which is where that initial check was, were all too oversubscribed, that if we didn't get in at C, we will not have owned this company. And this company is now showing a 400+X return on this particular holding. So that shows the power of going in early, let that winner rise, let the compounded return enjoy that time to deliver that return. And so, Marty mentioned this, and I wanted to say that this is why we were able to create these 30 unicorns repeatedly. We scaled them from C, and then we brought them to this current stage. And I just wanted to name a couple companies here. Rippling is one of the companies that we invested at C stage, write that first check before Kleiner Perkins came in and priced the Series A. We then did a super pro rata raise into the Series A. And then now the company is growing significantly year over year. They actually, sorry, let me finish this, I'll get to that. They actually raised a round in 2022. And then they just recently raised another round in 2023 in March. They held on to that valuation mark. So it shows that even though this is a growth stage company, but it is still staying at that valuation. Go ahead, Mark.
Can you define a super pro rata race?
Yeah,
If somebody, you're going to turn off the volume. Hold on. Somebody else. Okay, you can go.
Okay. Sorry. Is it me?
I got it. Go.
Okay. Super pro rata means that usually when we invest into one round, we then get a legal pro rata right to invest a similar size check into the next round. But because we know these founders, we invested in very early with them just when they're starting up. We usually have very strong relationship with these founders. So they're usually willing to help us elbow our room bigger to the next raise. So that's the super product.
I just have a quick question on relativity.
Yeah.
That Series E of
Yeah.
4.2 billion.
Yeah.
That was before they launched their recent rocket in Florida, and the rocket failed.
Yeah.
It didn't take liftoff, but they proved that the 3D rocket printing does work, but
Yeah.
they didn't get into orbit.
Yeah.
So my question is, as a manager, what happened to that valuation post that launch failure?
So, our fund valuation really is, we have a very strict valuation policy determined with our auditor, which is we mark to market.
I understand that.
Yeah,
That's not my
but aggressively, we will mark it down.
You will mark it down what?
I think we're still looking at the implication. Now, remember, we're still looking at what that implication is.
You don't understand yet what that 4.2.
Yeah, we'll likely mark it down. What we would do is likely 50%.
50% down because of the failure?
We tend to do very aggressively.
Right, but I'm asking you perceive that as a 50% hit?
With our own holdings, and
Yes.
I don't want to speak for the rest of
No,
the.
I understand.
Yeah, other people may value it differently.
Right.
Yeah.
Right.
I was curious how you do your.
Yeah, so we tend to market to the last round, but if something drastic changes, we conservatively market all the way down to 50. Sometimes we then bring it down to cost, but our cost base is very, very low for relativity space. We went in at, if I remember correctly, Jesse, it's like 10 or 15 million valuation. So even market down to 50, it's fine. Sorry, go ahead.
What's a typical size check you write in your seed round?
Yeah, so I'm going to get to that in a little bit, but I'm happy to kind of answer that shortly right now. So we have a bit of a what we call upside down model in that way. Our first check size tend to be between 250, about 250K check. And then in Series A, we can then write like, let's say, $1 million check. And then we follow even bigger. And that's because of two reasons. One, companies at the time that we're writing our 250K check are probably raising very little, less than $1 million. And they want to bring as many advisors into that round as possible. And also it's much higher risk. So then with our risk mitigation process, we then get to Series A, we then know the company is doing well, and then we write that $1 million check. So it's a little bit of upside down.
You obviously have anti-dilution rights.
Yes, we do. We do. Go ahead.
Regarding those entities up there, were the initial valuations of those companies started up between 2010 and the end of 2021? What were the years, those initial?
The most of our fund was started in late 2015. So most of these companies were invested in early 2016 or 2017.
That whole group?
Yeah.
Okay, so that was during a period of quantitative easing, but the Fed had a policy of quantitative easing, correct?
I think in
apologize.
small print, it says the data is as of December 2022.
As of December 20.
The valuation is as of December 2022. The initial valuation was entered in around 2016, 2017.
You typically the first investor in anything?
Well, typically, yeah, the first round, like the first institutional round.
Okay, so you don't get any tax benefits. You're the first investor in these.
I think we do get that Q. Are you referring to the QB?
Yes.
Q. Sorry.
QSB.
QS.
Small business. Don't worry, we got a lot of accountants here. So yes, and how do you pass that through to the LPs?
I would ask my CFO that question. I'm sorry. So, all right. So just moving on to look at the entire fund. So how do we do as a fund? The fund size is 115, and this is, as Marty has shared, we drastically marked down by December 2022, not including relativity space, but we did mark everything else that we need to adjust, and that still put us at about a 3x TVPI net. And then, the growth size is obviously a little higher. So this is where I was going to talk about strategy a little bit. We do screen about over 1,000 deals a year. Our graduation rate from that initial check to the next check is about 41%. Compared to the industry, about 30% from year 2 to year 5. And the reason that we're able to do this really is because we were able to access the C stage market broadly. So we see enough deal to then construct the right size portfolio. So then we understand the potential high risk characteristics of the early stage. But then we mitigate that by being able to see many deals in the same sector. And then we select those deals. And that's why our 41% compared to that 30%.
We have a question from the audience here. What's the max percent that any one deal can be in your portfolio?
Sorry, the
What's
max.
the max percent
The
that
weighting
you
on the
invest in
portfolio.
one company?
One company.
Like
Part of your fund.
part of the fund. The biggest company that we have, it's about $5 million into one single company. Because again, we're early stage fund. So by Series C and beyond, we actually don't necessarily participate. And then, I actually don't have the exit. I don't have a slide on exit, but a lot of our companies, we do exit like around Series C, Series D, when there's a big round coming in. And we did this several times already last year, where we then sell into that up round. So we were able to exit. All right, go ahead.
I don't know all your names on the portfolio companies you have, but let's say your next fund, quantum computing ecosystem is extremely attractive as a high growth area. And the seed stage is extremely low in price right now.
Yes.
So my question is, being forward thinking as you are you looking at the photonic space within the quantum computer arena and incorporating that and maybe fund 2 or whatever?
Yeah, we're certainly looking into a lot of that will fall into the deep tech space, the deep tech. And so certainly we're looking at all of that. We are actually taking advantage of what you're saying right now, is that there's a lot of early stage companies, and particularly in the deep tech space, where the valuation is extremely attractive. So we believe that now is the right time to make.
Right, because if you compare them to like IonQ,
Exactly.
which is $1 billion
Exactly.
for a hybrid computer. I mean, and the seeds are coming in at 5 million.
Yeah. Yeah.
The delta is huge.
Yeah, actually, I forgot that I was going to talk about my company, Boom. So Boom, I don't know if you know. So Boom makes supersonic jets. So we invested in them in 2016, and when it was just a YC, and the valuation was 15 million on a safe note, 50 million cap. So we went into them, and Boom is now, right now on this chart, worth 1.2 billion. They make supersonic jets, and they have a carbon neutral solution for, see, I know you will like that. That's why I mentally said, I got to talk about Boom. So it's a carbon neutral strategy to deliver supersonic travel for all of us in the room. And then, so now they already have purchase orders from United Airlines. They have purchase orders from Japan Airlines. And Richard Branson was supposedly have a purchase order, but we're not really sure. He may be thinking.
Is there another question over here? Do you have a question? John?
What sectors do you cover?
Can I come to that in a couple more slides? Not too
Yes.
much longer.
Absolutely, yeah. Don't want to get, was there another question over here on the far side?
Is it how she sources her deals, but I think she can get to that.
Can I come to that? Actually, one after this one.
It's an aggressive crowd, sorry.
It's okay. It's okay. I know. I wanted it to be interactive. So let me just take a moment and just share with you the team and a little bit of my own personal background. So we are a women-led fund. See, I know you like that too. We're a women-led fund, but we are supported by a very extensive team at AngelList, which is where I'm going to talk about a little bit of my deal source in. So I started my career as a physicist. I got my degree at Wellesley College in physics. Then I worked as 10 years as an engineer. I have 3 patents under my belt. Very techy, very nerdy. But then I did get on Wall Street for a few years. I worked at Lehman Brothers for a few years. And to be fair, I hated it. I did not enjoy working in the investment bank. And because it took me too far away from my passion. My passion really is tech, really is early stage tech. Given my physics background, I understand a lot of deep tech. I understand what you're talking about, the function.
You went to MIT.
I went to MIT. So I know all of that. And you put me on Wall Street, I felt really out of place. So I came back to Silicon Valley because I want to drive capital really to technical founders that have these bold visions like Boom, Supersonic, that transform industries, right? So I founded Upshot after spending 6 years in China from 2008 to 2014. I worked at Silicon Valley Bank. So you guys can look for me at break or at dinner. I have a lot of inside stories on SVB. But so I said SVB Capital China. When I moved to China in 2008, SVB has nobody on the ground doing SVB Capital. So they asked me to go there and help them set that business up. I went there, I helped them raise 4 funds. They are all RMB denominated, but they total up to be about 150 million USD. Invested in that China ecosystem, and I learned a lot. I learned a lot about the local China venture system, the ecosystem. But the most thing that I learned, the thing that I learned most really is from SVB. I understand and I realized how to service and how to finance early stage companies. Because SVB, for better or for worse, was definitely a key driver in that whole early stage ecosystem. And I learned that. I learned how to do that. I learned how to access the early stage deals. I learned how to support them throughout all these different phases of life. And that's how I can help my companies from seed to unicorn. I have 5 minutes left. Okay, I'm gonna move on. All right, then I have Anuja, who is my CFO. She also went to Wellesley about a decade after me. And then I have Jessie, who just joined us. She's in the audience today. She joined us just about a year ago. She also have a lot of public and private market experience. She went to MIT, but many decades after me. Okay, deal source. I have a relationship, as I mentioned earlier, with AngelList. Through AngelList, Naval Ravikant, very good friend of mine, know him for over 20 years. I sourced Notion, Rippling, for example, with Zach, with Imam, sourced a lot of deals through that whole AngelList platform. We also were able to repeat that with YC and with a few other top quality C-stage platforms. These are some of the people that we work with. They are all Silicon Valley insiders. Kevin Law and I went to MIT together. He was the CEO of AngelList. Naval Ravikant, founder, chairman of AngelList. Iman is the current founder, CEO of Mercury, which maybe a lot of you have heard of, is the leading fintech platform. And Zach Colliers, we sourced our first unicorn exit through him, and that's Cruise. Several others, because I have less than 5 minutes now. Okay, sector. Who asked the question on sector? There. We are cross-sector because we believe that at the earliest stage of the company, they do pivot, and they pivot so much, sometimes across sectors. So we don't want to pin ourselves into one particular sector. But the thing we do look for is enabling technology. The company have to scale with technology. And so that's how, looking backwards, we have a focus in enterprise software, fintech, AI-enabled. I talked about Boom already, and then healthcare. One of our company, Auto Pharmacy, doing extremely well. So those are the few sectors that we cover. I'm happy to go in deeper. Yeah, go ahead.
When you say healthcare, what do you mean?
Mostly digital healthcare, because I don't have a bio background. So just on the tech side, digital platforms.
You mean devices, medical devices?
Not even medical, not too much of that. We do look, I understand some of it, but I wouldn't say I'm the most expert in that.
Sorry.
Okay, our value add. How do I provide value to our companies? We have a global based LP. So what we do is we can provide a portfolio company taps into the global capital market, and we could have strategic conversation. We help them to have strategic conversations. I talked about Boom earlier. I introduced Boom to Baidu, one of our LPs, and then through that relationship, they got investment from C-Trip, which is a travel site. And then from there, they got attention to Japan Airlines. And then, go on and so forth. IvyFON is another example. They are our Amazon Go solution, cashierless checkout. They opened a store in Dubai with partnership with Carrefour. Very carbon neutral.
We have a question from the audience.
Oh,
Okay.
sure. Hi. It's a comment and question. The first comment is that there's an old saying that the only place that money comes before success is in the dictionary, unless you happen to be a venture capitalist. That comes before that. However, in an article I just read, they indicate that less than 15% of VCs get a 2x or 3x. What's your secret sauce?
Early stage.
So our secret
Just walked in.
Oh, sorry, you just walked in. Oh, wow.
What I want to do is this. We have, I'll give you an extra 2 minutes, and
Okay.
every question you have to answer in 30 seconds or less.
Okay, but could I just go over, this is my last slide, I
Okay.
promise. Okay,
30 seconds.
and I will come to you. So my last slide, really, I'm here to build long-term trusting relationships. And Marty has said that I need to be family office friendly, and I'm very friendly, and I could be friendly to family offices. So we put together 3 terms here that are friendly to family offices. One, I'm committed to share my deal flow. If you're interested in early stage, if you're interested in any kind of deep tech deal, we're happy to share. I'm committed to have a co-investment program with you. You get co-investment rights not into the fund two that you invest in, but you also get fund 1 companies. And we will talk regularly.
So many of these deals have super pro rata rights.
Right.
You don't have necessarily all the capital to do yourself. You can bring in.
Yeah,
somebody else.
exactly. Because fund 1 is at the point where we are really not looking to deploy now, because most of the company are Series C, Series D. So I'm looking to share that with all of you.
So venture capital, like many other asset classes, is a real dispersion between performance. Obviously, got to be a top tertile.
She's a top.
Top
decile.
tertile or top decile. So again, that's and how large is your first fund?
Right there.
115 million.
Sorry. Oh,
And fund 2 is 120 million.
Okay,
What's
sorry,
the entry minimum?
so it really depends on the entity. For corporations, we'd have to stay at 5, and the individuals at $1 million. Any other questions before Marty kicked me off?
So I will tell you, there were some questions from the audience about your filters. Maybe you can discuss it at dinner time.
Sure.
And then the other question I had was, are you typically a co-investor or the lead investor? In other words, do you put together the term sheet?
Yeah. So because of the safe note, most of my entry point is safe note, and there's usually not a lead. So yeah, we just participate in that safe note. And for Series A, we could lead, and in fact we led into IvyFON. So we could lead, but most of the time we work with the founders to solidify that A.
And the fact that you have a fund behind you, so this goes back to like the old New York Angels model, where like Fred Wilson was New York Angels invested $3 million a year, but $2 million of that was from Fred Wilson or Edison Ventures, and the other guys invested $25,000, right? So it's a very similar model where you've got these guys who are really fantastic super angel investors.
Yeah.
And then you come in, you're the big kahuna, and you just come in and say, great, let's do it.
Yep.
Right. We at some point, you're not gonna have time here to discuss how you do this, like your filtering strategy, but we would love to hear about it at dinner time.
Yeah. And again, we're here. Jesse and I are both here today, tomorrow. We're happy to have any kind of in-depth conversations with any of you, because again, we're friendly.
Fantastic, great.